Hi, this is Arvin Talley with Elixir Mortgage Lending. Today I wanted to speak regarding our loan programs here at Elixir Mortgage Lending. We lend in California and Florida on primary residence, and when a borrower calls in with their scenario, I wanted to kind of walk through what the process is, how we get to loan programs, and what you should also expect as a borrower. As far as when a borrower calls, our first job is to make sure that we understand if they have income and how their income is being produced. In the case, I'll start from the top of the food chain, and the top of the food chain, as far as loan programs goes, is conventional programs. Conventional loan programs means they're, generally under uh, conforming limits, or if it's non-conforming or high balance, it's loans under $1 million seem to do the best, honestly. And when they go over that, there are loan programs as under Fannie Mae or Freddie Mac, but they can get stringent. So where it lands is basically in the entry level to the medium price ranges of homes in the California or Florida. And as far as conventional loans go, they work really well with W 2 income. W 2 income, we can go with the gross income. With the self employed borrowers, we have to go with what's left after deduction, and that will complicate the matter because most people write off a lot more just so they don't have to pay Uncle Sam, and that usually doesn't work as well. As far as these loans go, we can do loans from 620 and up FICO. Generally, anything under 640 gets a little dicier, so 640 and up is where I'm going to say. And above 680 is when the borrower starts experiencing better pricing, lower cost. And that's where conventional loan strength really start. For borrowers who have 740, 760, 780 plus FICO scores, these loans really work out well. And as far as the cost goes and everything else, and the process being streamlined way better as far as getting into the process and out of it, and closing time periods. And if for borrowers who are first time home buyers over 680 FICO score, you can get in with 3% down. And you will have mortgage insurance. Anything less than 20% down, you'll have mortgage insurance, but you could get in with 3% down. And bare minimum down on a standard conventional is 5% down. We can finance up to 80% on a cash out or a refinance. So we could combine first and second loans and all that good stuff. And as far as debt to income ratio, referring to what money is coming in per month and what's going out, we have ratios for that. They're pretty lenient, not as lenient as other programs, but they reward us with price and cost. Now, if a borrower has credit blemishes or history of bankruptcy or maybe missed payments or anything that might be a mark on their credit, especially if their maybe FICO is not as high, they have an option of going to FHA or VA loans. They can carry a little bit of blemishes and they are still low down and work just fine. As far as these type of loans, they do have a little bit more cost. In the case of FHA, they'll have mortgage insurance. They usually, whether it's FHA or VA, will have some type of upfront mortgage insurance. Veterans, sometimes disabled veterans, they can bypass the funding fee, which is the upfront mortgage insurance that they're charging. But the caveat to these loans is the property has to be in good shape. If the property is in not great shape, the appraisal on those can be sticklers and they could require a repair list and things like that that could complicate it. And the process is not as quick as conventional, but it's still fairly swift and streamlined. FHA loans work really well, or VA loans work really well still with W-2 income. They, again, with anybody that is in the bracket of self-employed, we go back to what they have for income on paper, and if they don't show enough, it could be complicated. Then the next tier after these type of loans is non-QM. Non-QM kind of sounds like a clunky name. Probably 10, 15 years ago, this is the category where was categorized as subprime. Now it's like kind of renamed, but it's not just subprime loans in there anymore. This is mainly for borrowers who are self-employed. Self-employed borrowers, we can go with your cash flow, which means every month, whatever you deposit, we can use a percentage of that to qualify you. We can go with asset depletion, which means if you have liquidity, we could convert it on paper into income. We can do P&L, which with certain industries or businesses, it could work out okay, where you would go to your CPA and get a letter, and we may be able to do it that way. But most of these loans, truthfully, they work out to more cost, higher rate, but qualifies the borrower with more streamlined as far as without income. These work out very well for self-employed who have good credit. The one thing about these type of loans, though, it takes more money to do them. They have reserve requirements. Bare minimum, really high credit score might be 10 to 15% down. In most cases, you need 20% down. And we can do these from 300,000 and up. We can go into the millions on these. And these type of loans work really well for self-employed who they have good credit, and they can qualify for it with just deposits and the liquidity they may have. And if the non-QM part has another part which it works with lower credit scores and things like that, which we don't really touch or do as much, simply because they get much more drawn out and complicated, and the experience generally we find is not as easy, because the more paperwork clutter we end up with, or the longer the time drags, especially on purchases, it's not it becomes a nuisance as far as a process. So we just do from mostly 660, 680 FICO and up. Then the next category after non-QM for borrowers who have money, this is not going to be a borrower that's trying to squeeze into it, but it's going to be a borrower who has money and finances, but maybe doesn't show income on paper. We can do stated. Stated for primary residence, it depends on credit score. The higher the credit, the less reserve you require. The lower the credit, the more reserve. So if somebody has a 780 or better FICO score, I need 3 months reserves for them. If, they're going to need 25 to 30% down, but we can basically with 3 months reserves qualify them. But in some cases, we can go 20% down, by the way. But if the credit score is lower, it's still going to take 25 or 30% down. The only major difference is they're going to now need somewhere between 6 months and 18 months reserves. And reserves is going to be your principal, interest, taxes, insurance, any other cost the housing might have to be coupled with that. These loans can go down to about I believe 640 FICO score, but they are not going to reason out very well, really under anything under 680, I'm going to tell you. This works really well for somebody who has money sitting around in the bank, probably has a higher FICO score, and could meet the reserve requirements and the down payment and the cost. There is a cost associated with doing a stated loan, because these are going to be a little bit more risk, even though somebody could have good credit and have money. We're not asking for income in that format, but we have to show on paper the ability to repay with reserves and the down and everything else. There are options for hard money, which we don't offer for primary residence. The problem with hard money is it gets more complicated to show ability to repay, and they are kind of on the gray line. We don't do anything as far as hard money and that goes, but these are the tiers from conventional to FHA and VA to non-QM and down to stated. Stated rates are going to be in the 6s and 7s. These are longer term loans still. There's no prepayment penalty on anything that you live in, but the terms are not going to be as good. But it still opens up the door for a lot of folks who have been struggling to show income to qualify. I hope I answered all the process and the steps. And if you have any questions or a loan scenario you want to go through with us, you're welcome to contact us here at Elexor Mortgage Lending. Thank you.